Hey y'all, Jen Hernandez here with Loan with Jen. So why would you put 20% down on an FHA loan if you can't waive PMI? Stay tuned and I'll tell you the reason. Okay, everybody, we're back. So, some people need an FHA loan. FHA loan stands for Federal Housing Administration. FHA loans are fantastic when people have credit issues. You might have had a bankruptcy or a foreclosure in the last 2 to 3 years. That is a perfect candidate for an FHA loan. Conventional requires that you have 5+ years, 7 on a foreclosure. The other reason is credit score. Some people just have things happen and their credit just hasn't recuperated and their score is in the 600s. And FHA just gives rock star rates for people that have lower credit scores. So sometimes that's the reason. The other reason is debt to income ratio. So FHA allows up to a 55% debt to income ratio, meaning for every $1 that somebody earns, 55% of that gross number, $1, before taxes, can go towards debt service. So that includes house payment, student loans, car payment, all those types of loans, okay? Now, there's lots of ins and outs that probably out of the scope of this video that we could cover in another video. But bottom line, FHA for some people is the only way that they're going to be able to get in a house, take advantage of low rates, lock in their value before things start to appreciate. It can be a really great option. Now, the only downside, if you want to call it a downside, of FHA is that the PMI is for at least 11 years. You've got to put down 10 or more percent, and your PMI is, after 11 years, 121 payments, then it removes, okay? If you put 3.5% or 5% down, it's for the life of the loan. We've got another video on how to calculate PMI. So I hope you have found this helpful. Talk to you soon. Legacy Mutual Mortgage is an equal housing opportunity lender. The opinions expressed here do not reflect those of Legacy Mutual Mortgage.